Good morning and welcome to our 10 minutes at 10 or just after 10 live today. We've been asked a lot of questions recently on management accounts and how do we know whether they're accurate and up to date. So we thought we'd take you through the top 7 issues we see when we take on a new client and we start to look at their management accounts. So these are the things that we first have to go and fix when we meet a new client. So what are these errors? We're just going to switch over into a demo environment and we're going to look at them and show you where we would look at in Xero for these typical types of errors. So looking at the month-end accounts, the first thing we often see, the thing that is most wrong on a set of new accounts is that the published accounts do not match the figures in Xero. And what that often means is that the accountant hasn't put the end of year journals into the Xero account or into QuickBooks or whatever system you're using. So quite often what's published doesn't match what's actually in the accounts. So if we had a set of published accounts, say you look at your accounts on Companies House, Harry, can you go into the balance sheet here and look at an annual set of accounts, and let's look at what figures we should be checking to see that they match. So Harry's going to take the last year end accounting date. Now we always look at the current year end simply because it helps us see what's in our current year to date versus what's our previous actual live year end. So here, of course, we haven't got to the 31st of March 2020 yet, but we would have got to past the 31st of March 2019. So the first thing to do is just look at the total equity line right at the very bottom of the accounts, and that should match the balance sheet of your published accounts. And if it doesn't, then you need to go back to your accountant and ask them to make the changes, do the adjustments in your accounting system to make sure that your accounting system then matches your published accounts. Now, if it doesn't match your published accounts, then your payables will be out, your receivables will be out. Quite often the tax calculation for the year is not in Xero or QuickBooks, and so your tax liabilities aren't there. And any adjustments that the accountant has done at the end of year to produce your end of year accounts has not been reflected by journal in your accounting system. And if this happens year on year on year, your accounts that you're working on get further and further away from the accounts that are published, and you're never really working from truly accurate figures. So if you notice that figure's not correct, then go back to your accountant and talk to them.
And likewise, if you notice the figure is correct, I'd really recommend locking your account so you can't accidentally post something back to the period.
Yeah, that's a really good idea.
So,
and if you don't know how to do that, your accountant can.
Yep, and then they can set up a locking period. And then that way you're just making sure that they stay that way.
Absolutely. It's really easy to make errors and post things in the wrong year. So whether it's payments or invoices or receipts, it's often done. So a good idea from Harry there. So first issue is that the published accounts obviously or sometimes don't match the system accounts. The second issue that we see when we look at a new set of accounts is that the bank is not reconciled. So if we're just going to pop it into the dashboard here, and what we look for is how recently the accounts have been reconciled. So we assume that the statement balance is correct. We often check that with a new client when we take them on board just to make sure that their accounts are up to date. Things do happen, and sometimes duplicate transactions are imported or a transaction is missed. So it's super important right from the get-go to make sure that that statement balance that's showing in the account here matches the statement balance on the online banking. So don't just assume it does, go and check that it actually does. Now, another key report in Xero, we've just looked at the balance sheet, is to actually look at the reconciliation report. So if you just go to the 3 bars there, and we're going to look at the reconciliation report. Now, every Xero account has this. Very rarely do people use this. So if we did, say the last month end, let's do the 31st of January and update this. What you're looking for in your bank reconciliation summary is anything that is marked as unreconciled that's over, say, 10 to 14 days. So it might be that you haven't actually reconciled those transactions in your bank, and it could be that you've actually duplicated them or missed them. So anything within sort of 10 to 14 days is sometimes a timing difference. You might be waiting for some information, you might need to put some adjustments through, that's fine. Anything beyond that, I would be looking into and looking at whether those transactions are correct. So here, for example, we're in January 2020, but we've got transactions that are unreconciled going back to July, September 2019. So those ones I would go and investigate. Now, this bank reconciliation summary is available in every Xero account, and it's really, really key. So go away and check yours and make sure you haven't got anything unreconciled that's more than 10 to 15 days old. Generally, I would try and keep your accounts reconciled weekly, daily if you've got time, daily certainly if you've got a bookkeeper, and try and keep those up to date. So the more up to date your accounts are, then your age receivables and your age payables are up to date, so you know who you owe and who owes you, which is massively important when you're running your own business. Right, so number 3, most common errors that we see are missing sales. So here we're going to pop into the P&L, and quite often what happens is a customer has forgotten to raise an invoice, or perhaps has done the work and then not raised the invoice. Time passes and then they think, actually, I'm a bit uncomfortable, I'm not going to raise that invoice now, because they feel like too much time has passed and they don't feel comfortable raising that invoice and admitting that they've forgotten to raise it. But the chances are that the customer knows that you've done the work and you haven't billed.
Oh yeah,
and
they'll be well aware.
And they won't be surprised if it comes through. They might be a little bit miffed, you might have to apologise, but better to apologise and raise that invoice than it is to miss that income altogether. Now, there's a whole nother conversation around missed opportunities for sales, or not having a proper sales order process in place. So quite often a client rings up and says, could you just do this, could you just do that, and you do the work and then you don't have a proper process in place for tracking that work, and you forget to raise those sales in the right month, and that in itself also becomes a problem. So you can use the Xero sales order process to make sure that you track any requests for sales, agree the price for that sale, and then get the order placed and accepted by the customer, and then you can convert that sales order to an invoice once the job's done.
Now, if you also carry out sales invoicing from a different system and import into, say, another software such as Xero, QuickBooks, etc., then basically we're looking for a control where you can basically cross-reference what's actually raised in your invoicing system versus what's in Xero. Because often we do see there is some, I don't know if it's transitional error or just things just haven't all been imported across a given period, but sometimes we do get items which aren't imported in here, but there are in the actual invoicing system.
Yeah, and quite often we see that clients assume that sales process works and all of the invoices raised in System 1 are going to be imported into their main accounting system. And quite often when we go back and double check and do an audit, we find there's something missing, or perhaps a credit note has been raised and that's not been imported either. So super important to have some sort of control in place at the end of every month or quarter to make sure that you check that all of the sales raised in your sales system have been imported into your accounting system, and then of course that you've collected the cash for all of those. So number 3 is missing costs. Now, another real common error is missing costs. Now, invoices come in from your suppliers, they come into your inbox, they come in via paper. It might be that you've been out and personally spent some money and forgotten to claim that back. And what happens is that the costs then are missing from your accounts. So you're not reflecting the right cost of running your business, and you're not reflecting the right tax position. So you're potentially overpaying on taxes because you haven't put all of costs through. And this is a challenge where in some businesses there are more than one people who have the authority to spend, and so those invoices sit in multiple people's inboxes. Now, in those instances, you can do things like set receipt bank up, so the receipt bank has rules from your email to auto forward invoices into receipt bank. You could set up a separate accounts at your company name inbox so that all of your sales are going out from that company inbox and all of your receipts and costs are coming into that company inbox, thus ring fencing them into a single accounts function inbox. Now, the beauty of being able to do that, even if you're a small sole trader or one-man band, the beauty of being able to manage that is that you can then outsource that job to a bookkeeper who can then keep control of those for you, and you can spend your valuable time going off and doing something more important instead, like generating more sales.
Now, if you have reconciled your bank account fully, you'll usually find you hopefully identify a lot of these in the first instance. But what you might actually find is on some of your supplier accounts where actually you have credit terms, you might be missing items. As an example, in December 2019, I know full well I should have had a purchase for my cost of sales account. It might just be that actually you haven't paid the supplier yet, but the invoice is well and truly raised. So when you get these items, if you can access a statement from the supplier, definitely do. Might be that they automatically generate one and issue it to you anyway.
Yeah,
if they don't,
then
please
double
do
check.
request one, because that's probably one of the quickest ways to identify whether or not you're missing a spend. And also, if you look at your profit and loss and you compare the periods and look at, say, I don't know, 6 months worth of data, you'll usually find that your trends will give away a bit of a hint as to whether or not you're missing any spends.
Yeah, so it could be that they're in the wrong place. It could be that the invoice hasn't gone in altogether. And then, of course, it's always a shock when the supplier sends you a statement that says, right, you owe me X amount when you thought you owed them something completely different, and often a lot less. So that's save the cash shock and the cost shock by making sure that you've captured that cost in the first place. Now, you can get your suppliers to send your invoices directly to your receipt bank account if you've got one, and that's a super clever idea and helps a lot of people manage their cost side. Now, issue number 5 that we often see is an inaccurate DLA. So the director's loan account, either you're not showing the correct amount drawn, or they're not showing wages payable that should offset their director's loan account, or they're not showing personal spends or mileage or whatever. So quite often the transactions that ought to go into the director's loan account to reduce the liability actually end up in the profit and loss account as a cost. So you end up overstating your profit and loss account, you're understating your tax liabilities, and you're understating your director's loan account. Now, the problem with not keeping your director's loan account up to date and not understanding how much the business owes you or you owe the business is that you don't know until too late in the day how much dividend you have to declare to clear it, or how much cash you can draw out tax-free if the business owes you money. So if you're not sure about your director's loan account and how much you owe the business or the business owes you, then have that conversation with your accountant either monthly or quarterly at the very least, to make sure that you're on top of that on a month-by-month basis. Now, biggest error number 6 is tax. So let's just pop back into the profit and loss account. This is not so much an error as a missed opportunity. So with our clients, we like to accrue the tax due on operating profits at the end of each month or the end of each quarter, depending on the contract that the client has. So by accruing the tax, so first of all, I have to make sure your management accounts are correct. And then by accruing the tax, you can keep an eye on how much you should be putting aside for the end of each year for tax liabilities payable 9 months after the year end, assuming this is a limited company. So we would have our account code detailed, so corporation tax for the year 1920 due 31st of December 2020. So we like to accrue this ahead so that we can tell our clients how much tax needs to be put away. Then check at the end of each quarter or each month that you've got the right money put away into a corporation tax account, and also make sure that you double check. So say, for example, you have a late invoice come in. If you have a late invoice come in that affects December's costs, go back and adjust the tax accrual to make sure that it is 19% of the operating profit, less depreciation. So don't forget about the add back of depreciation. Now, one of the things that we like to do in our clients' accounts is have that corporation tax showing on the dashboard. So if we pop over to the dashboard, we can see that the provision for corporation tax for the 19th of December, for the 31st December 2020 is 2,700, and you can also see that the tax due for 2020, actually we've got sort of duplicate account codes here because we've that's really odd.
Has been renamed, so
well,
I know that's
that's the corporation tax liability in the P&L.
Yeah.
And that's the liability in the balance sheet. So that's a glitch that's come up since we'd set this all up earlier this week. So we shouldn't have that corporation tax charge in there.
We'll have to remove that one.
Yeah, so that's not necessary. So check your accounts watch list and make sure that you've got your corporation tax charges in there. So you can see we would normally have had one for the previous year, but because that has been paid, that no longer needs to sit on the watch list because that's all done. If it was overdue, we would have that still showing there. So let's pop back to the balance sheet. And in here we should see our provision for corporation tax is due in our liabilities. There we go, and you can see how it changes month on month. So we did an adjustment there. We did an accrual. What month is that? December? Yeah, one for December, one for January, but we haven't done February or March yet, obviously, because those periods are still part way through. So, biggest issue number 7 is personal spends. We kind of alluded to this a little bit earlier. So quite often, spends that are intended to be personal, where the business owner has accidentally used the business card instead of their personal card, or they've spent money on behalf of the business but haven't claimed it back, there's two issues at hand here. So either they've used the business card and posted it to the P&L in error and written it off as a business expense when it isn't, it should have gone to the DLA, or they haven't claimed spends that they have made on their personal cards, which would reduce their DLA. So keep a real tight control of your personal spends. Make sure you only ever use your personal cards for those. And if you have to use a business account card instead of your personal card, make sure you code that and offset it to your director's loan account. So the exercise from today is to go back and have a look at your accounts and check to see that you're not making any of these 7 errors. So check your published accounts and check that the balances in the balance sheet match the accounts in your balance sheet, in your published accounts. Check that all of your banks are reconciled and run a reconciliation report to make sure that you haven't missed anything and you don't need to go back and make any adjustments. Check for missing sales, check for missing costs. Talk to your accountant and make sure that you understand what your director's loan account is and how to reconcile that. Check for tax. Another error we sometimes see is that tax paid this year that relates to last year is paid in the P&L by mistake and it's not offsetting the liability in the balance sheet. So check your tax accounts. It should be roughly accrued on about 19% of your operating profit. So you can do a quick manual check just to make sure that it makes sense. And then look for personal spends, either personal spends that have gone through the business that shouldn't be business costs but belong in your DLA, or look for spends that you've made personally but you've forgotten to claim back. So missing personal expense and missing expenses are really, really common errors made in business accounts. So that's it from us today. I hope you enjoyed this video. If you do, please give us a like and let us know what you enjoyed about it and how we helped you. If you have any queries, please drop a note in the boxes below and we'll help you. So that's it from us today. Bye for now.
Bye.
Bye.